Welcome to The Explainer. Today, we're going to tackle a huge concept, one that's really at the core of our entire financial world: market efficiency. Now, I know, it sounds a little academic, but trust me, this idea affects every single investment you might make, every stock price you see, and honestly, the health of the whole economy. So, to get our heads around this, let's start with something simple. Imagine you're out buying a used car. You find one that looks perfect, great price. But what if the person selling it knows that it was in a massive accident just last year and they just forget to tell you? You'd end up paying way more than the car is actually worth. That difference right there between what the seller knows and what you know, that's what we call an information gap. And in the world of finance, that very same kind of gap can be the difference between making a really smart investment and a very, very expensive mistake. So the big question is, how do financial markets try to close that gap? How do they try to make sure that everyone, from a top-tier analyst to an everyday investor like you or me, is basically working off the same map? Well, the answer is this really powerful concept called market efficiency. You can think of it like the market's information engine. It's this whole system that's designed to process and spread information so fast that the price of something, like a stock, should almost instantly reflect its true fair value.
Okay, so let's really dig in here. What does a truly, a perfectly efficient market actually look like? What are its defining features?
In this ideal world, it really boils down to three key things. First off, values are fair. A stock's price isn't just about hype. It's based on all the available information about what that company is really worth. Second, there are no easy surprises. Prices only make big jumps when something truly new and unexpected happens. And third, capital gets allocated smartly. Money just naturally flows to the most innovative and well-run companies because their fair price shows their potential. And all of that builds a ton of confidence in the system. Okay, so that's the theory. But what does this actually mean for you and your own investment strategy? I mean, if the market really is efficient, how should you behave?
Well, the theory gives us a pretty clear playbook. First, don't waste your energy trying to beat the market. Hunting for that one undervalued stock is a tough game, because if the market is efficient, all the public information is already baked into the price. Second, diversify. It's just way safer to spread your investments across a lot of different stocks, instead of betting big on just a few. And finally, you gotta play the long game. A buy and hold strategy pretty much always wins against trying to perfectly time the market's crazy ups and downs.
And this is a big but, markets aren't always perfect, right? So what happens when that information map is wrong, or when key info just doesn't get out there? Well, that's when you get inefficiency. Let's look at a classic example here. So you've got this analyst, and they're only looking at a company's past earnings. They see low profits and say, sell that stock. But they completely miss all the public chatter about a game-changing new product that's about to launch. Because they're only looking in the rearview mirror, the information flow is broken, the stock price is wrong, and the market is, for that moment, totally inefficient. And this just lays out the difference so clearly. An efficient market, that's built on full information, which leads to fair value and confidence from investors. But an inefficient one, it's full of hidden information, which just fuels speculation and creates a whole lot of instability. Now, this is where it gets really fascinating, because this hierarchy helps us understand that there are actually three different forms of market efficiency. If prices just reflect old price data, that's called weak form efficiency. If they also reflect all the public information out there, like news reports and company earnings, that's semi-strong form. And that's what most big markets today are aiming for. The ultimate perfect level is strong form efficiency, where prices would somehow reflect even private insider information. But in the real world, that's impossible, which is exactly why insider trading is illegal. Okay, so let's take this theory out of the textbook and see how it actually plays out on the world stage, because not all markets are created equal, not by a long shot. So you take a market like the United States. It's considered highly efficient, operating in that semi-strong zone we just talked about. And why is that? Well, think about it. We have a 24/7 news cycle and really strict laws that force companies to report their information accurately and on time. All that creates a ton of transparency. But then you look at the flip side, like the Greek debt crisis. I mean, this is a powerful, real-world example of what happens when efficiency completely collapses. When it came out that the country's financial data was unreliable or hidden or just flat out wrong, investor trust just evaporated. The market had no idea how to price things correctly, and the result was chaos and massive economic instability. Okay, so we've covered the theory, the playbook for investors, and some pretty dramatic real world examples. So, what is the one single most important thing you should walk away with here? It's really this. At its best, market efficiency is a powerful force for good. It's the system that's supposed to channel our collective investments, our money, towards the most productive, most deserving companies, all by making sure a simple stock price tells the truest story possible. But that leaves us with one last, kind of nagging question, doesn't it? If this whole theory is about logic and perfect information, why do we still see these completely irrational bubbles and devastating market crashes? Well, it turns out the answer has less to do with data and everything to do with human psychology. And that, well, that's a story for another explainer.